So why are investors so jittery as we change the calendar from August to September? Well, I think I have three ideas as to why. Number one, even though we did have a bit of a pullback in August for the markets, we saw the last week, week and a half maybe, of August actually good for the markets. The markets actually moved higher. So the decline wasn't that bad. And so we entered September near a 52-week high. We also entered into September at a high valuation for the markets. And that also can be a bit of a problem. And third, September seasonally is a difficult month. We, for whatever reason, tend to struggle. People come back from their cottages. We're just getting started once again. As I said earlier, I call it a new year has begun. And when you head into September, historically the weakest month of the year, and you're coming into September at a 52-week high, at PE multiples that are at the high end for the S&P 500, somewhere in the 18 to 20 range, I think investors start to get a little bit spooked. We're starting to see short sellers making larger bets that the stock market will fall. We have a couple of charts here to show what we're talking about. The S&P 500 chart first. You can see that even though we had a bit of a downturn in the month of August, we ended the month on a bit of a high note. Not as high as where we were at the start of the month, but pretty good. So we came into September just under 4,500 on the S&P, which again, not, still down from the all-time high, which was around 4,800, but still in pretty good shape and at or near a 52-week high. The second chart that we have here, which I think is a fantastic chart, which shows PE multiples, the 10-year PE multiple ratio. And you can see when it spiked, I guess, back in 1999, we had the dot-com bubble, and then it came crashing down with the market. The PEs came down. We also saw it spike a little bit to 2 standard deviations above the norm recently, coming out of the pandemic, and then we saw PEs fall once again. So here we are, August 31st, 2023. PEs are about 1.5 standard deviations above the norm, which usually means we're a bit overvalued. And make no mistake, traders, hedge fund managers, mutual fund managers, they look at this information and they know that coming into September, a seasonally weak time of the year, and we're coming in at a strong point, or with the markets and individual investors feeling good about the markets. So, of course, the contrarian that these traders are, what do? They start to make bets that the market will pull back. And so for me, as I've said on radio show and other shows, if we can get through September in and around the break-even point for the month, I think that would be a win-win for all of us. And as we get closer to the end of the year, as we move into the fourth quarter, when we get those final interest rate announcement, and hopefully the announcement that interest rates will stay at these levels, perhaps for the foreseeable future, but that will not be any more, any further interest rate increases, I think this could set us up for a pretty good fourth quarter. So I guess the thought is coming into the fall and into the last month for the third quarter, into the start of the fourth quarter, investors are a little jittery, a little nervous about valuations, a little nervous about how well the market has done, really on the back of technology and maybe even just 7 or 8 companies, the big cap tech names. We haven't seen market breadth start to pan out and to grow. So we've seen a very narrowly focused market. So that too makes things a little bit more jittery. But overall, I think if we can get through September and head into the fourth quarter, and we can hear from our central banks, Bank of Canada, Fed, things that the interest rates will be on pause heading into 2024, I think this market can gain some traction and individual investors can start to feel positive again once we get through September.